Right, good morning, everyone. My name is Chris Maguire. I'm hosting today's event. The doors have been opened, the virtual doors have been opened, and the hordes are streaming in to hear our assembly of experts. This is Napthens event. We're looking at the subject matter is exiting a business in the COVID world. Can you believe it's been a year now since we've been in lockdown? My name is Chris Maguire. I'm your host today, so I'll be asking the questions. As the financial year draws to a close and business owners take stock, our panel of experts will take you through the process of selling a business through a pandemic and what a collection of speakers we have got. Some of them can't afford to put the lights on, looking how dark their images are, but we've got Napthens award-winning deal makers Keith Melling and Richard Robinson. They're in alphabetical order, not in order of importance. We've got private equity board director Paul McClusky, and we've got Kieran Lawton, a senior investment director at Palatine. Welcome one and all.
Morning, Chris.
Good morning to you all. If you want to follow the conversation or you want to post a message or a question, there's a chat facility at the bottom. There's also a question and answer session as well. Today's event is being recorded as well. So what we're going to do, I'm going to take you through the panel. I'm going to ask them a raft of questions each, and then I'm going to open it up to questions for the whole panel together. I'm going to start with Keith Melling. Keith, first thing I always ask, actually, I always try and find something out about people that they don't necessarily know, the audience don't know. And I understand of a good source that you've taken up Warhammer during the lockdown. Is that right? I mean, I didn't even know what Warhammer was. What's Warhammer?
No, it's an extremely expensive hobby, which involves spending lots of money on small bits of plastic, gluing it all together, painting it, and then basically just being beaten by your son at every opportunity. So that's what I like to do when I'm not doing deals over the pandemic.
And you'll be telling me next that you've looked at Warhammer's accounts just in case.
Yeah, and it's a very profitable enterprise. I recommend shares in that company, absolutely.
Okay, fantastic. Look, Keith, you were a deal maker of the year as long ago as 2006. I remember it, actually. I think you were about 43 at the time. You've seen most things. The corporate team at Napthens, when you joined, is a lot smaller than the team now. How big is the team now, and how big was it when you joined, Keith?
Yeah, well, so when I joined back in 2010, we had about 5 people, and it's come off the back of the recession at the time and the credit crunch. We've now got well over 20, and that's largely through organic growth. We found that the demand's been there, certainly. We've expanded into specialist areas, so we're covering insolvency work as well as the pure corporate work. And we've just managed to find the right people through either our existing sort of trainee pool or through bringing more experienced lawyers from large practices. And it creates quite a nice dynamic, actually, because you get people who've been with the business from qualification and their experience, but learning from guys who've been at larger practices and what they can bring to the party, which is great. And just over a year ago now, we won medium-sized law firm of the year at the, if I can say, Insider Awards. I'll just say it once.
I still get on with Insider very well.
Yeah.
I mean, Napthens and your good self, and Richard, very well respected. I mean, I'm going to ask a question in terms of what your geographical hub is. Most people would assume it's Lancashire, but you just opened an office in Liverpool as well. I mean, do you see yourself as being able to do any deal of any size, whether it's Lancashire or not?
Yeah, I think that's right. Our heritage is definitely Lancashire. That's where we've been based predominantly, where the majority of our clients have been based historically. But I think increasingly we see ourselves as a Northwest firm. The starting point coming out of the last recession was for us to talk to local Lancashire-based businesses about us being an alternative offering to the larger city practices. But I think we're now so well established, and I think Lancashire's currently our mainstay, but word's got further afield about how we work and the calibre of our people. And so we're responding to that interest by, for instance, opening up in Liverpool. And I think it's interesting that, everyone's finding geography is becoming less important. Everyone's, able to do deals more remotely. So it maybe does become a bit less relevant where you are. But for us, it's about being that alternative. And, we provide fixed price, HR support, full service on an annual return to compete against the likes of Peninsula. And that happens, for clients nationwide, all across the country. So, yeah, and I'm currently doing a deal at the moment, for instance, for a London-based PR company. So we have absolutely no connection to the Northwest. So, absolutely.
We're here to talk about deals. It's important to set the scene, which we've done. Have you got a sweet spot in terms of deal size, Keith?
I would say that if you look at the average numbers, it's probably anywhere between 1 and 10 million makes up the rump of our work. but we've seen actually more above the £5 million mark over the last sort of 6 to 12 months, I'd say. But right now, I know that in the last few months we've done at least 2 over the £20 million mark, and we're currently working on. Richard's working on one at the moment, which will be our biggest transaction ever by quite a significant stretch, and that's a great coup for us to be doing a transaction of that sort of size. Being based where we are.
If we take ourselves back to March last year when Boris Johnson made his announcement of the first lockdown, what did that do for the deals market?
Well, my experience, I think our experience as a department, was that we had a very quiet April and May, it's fair to say. We had some deals that continued, but many went on hold because both buyers and sellers really had to understand what this completely different landscape, this huge worldwide event, meant for the businesses. I mean, Kieran can speak more knowledgeably about private equity, but from the people I spoke to who were managing, say, VC funds, for instance, they were saying, look, we're just sort of focusing on supporting portfolio companies and working out, what government support's available. Can we get CBILS loans? How's that going to work? Can we use the furloughing scheme and so on? So I think there were a good few weeks and months where people were just sort of sticking to their knitting and just making sure that the businesses they had were basically safe and managing and coping and responding. I think that's the key, was about responding at that point in time. I think then things started to warm up towards the autumn and deals were reinvigorated. And I'd say that out of, say, 12 jobs I was working on in March or April, which went on hold, I think around 10 resurrected themselves pretty much on the same terms. And now there seems to be a lot more pent-up demand from buyers to make acquisitions and from sellers who decide they now want to exit.
Yeah, I was going to say, I mean, there was an attitude generally of everyone sitting on their hands to see what the new landscape looked like. Did you lose any deals at all? You mentioned you're working on 12, 10 came to market. Those 2 that didn't, are they still in the mix?
I would like to think so, yeah, because I think the underlying business is a good, strong business. It's a very sustainable model, and it's got a good management team behind it. It's just the fact they're in a particular sector, for instance, where it really just dropped off the edge of a cliff, and it was about managing the impact of COVID on that particular sector. I think there's not many sectors who face that sort of issue. But one that did is the company I've got in mind. It's an absolutely fantastic business. It's got a very strong shareholder base, and that they will thrive going forward. It's just the fact that they've almost had to mothball things for the last 12 months.
Well, I was going to ask you about the same thing in terms of the impact on different sectors, but it's relevant to my next question, which is about multiples. Have multiples held up? And obviously, if you're in the travel and the hospitality sector, the multiples are going to be a lot less than if you're in the IT, the SaaS-based healthcare sector.
Yeah. In terms of the multiples, I think the multiples, obviously people talk about ranges of 4 to 8, broadly speaking, but then you'll get more exceptional higher multiples where you've got very strong recurring income, healthy margins, and so on. Often in the sort of IT sector, maybe. So it's I think it's not so much about the multiples, maybe about the maintainable earnings. So if you can demonstrate that you have, maybe you've had an impact from COVID, but it's been a blip, and you're now back to where you were originally, or actually even better, you're stronger if you're particularly in the healthcare sector and you're supplying PPE equipment, for instance. Or maybe it was it's something which has impacted you for the long term, but you've managed to cope with that. So it might have depressed your margin a little bit because you've got increased insurance premiums, you've got to spend more money on health and safety compliance, for instance, but you've been able to pass that on to customers and the margin is still strong. So I think it's about the maintainable earnings. But what I would say is that I think that maybe there's more deals where the purchase price is becoming deferred, or it's being rolled into equity. So I think buyers are quite keen to preserve the cash position where they can. And I think they're also rather nervous about paying too much up front because there's still a sense of no one knows what's coming in the long term. And I think what they're saying to sellers is, look, we almost like want to co-invest going forward. So you either take a deferred payment and we'll see how things go through some sort of earn-out, or we ask you to roll into the equity and help see us through this, and then we sort of share the risk together. Maybe that's more of a feature.
They're a very good business. I won't name them. I know them very well. They recently got acquired. A relatively multi-million pound sum, but a relatively modest initial payment, but a big earnout based on very competitive, productivity targets. Is that the model going forward in terms of that big check size at the start won't be there for a while? Is that your view?
Well, it depends what business you're talking about. And to go back to the point around, if you've got the recurring income and the strong margins that's maintainable, I think then, you'd be well advised to stick at wanting a decent price tag on day one that you get some cash out. I think where there is a little bit more uncertainty from the buyer's perspective, because maybe they're trying to make a strategic investment, but actually, is it going to be what they expect it to be? And particularly people-based businesses as well, where you're relying upon the ongoing participation of the previous owner to secure the growth, then earnouts, I think, will always be a feature. And if you're acting sell side and you get that sort of proposal, it's not necessarily something you wouldn't do, but you just got to really make sure you engage closely with your advisors, particularly your corporate lawyers, to make sure you've got the right sort of protections in there, and make sure that, for instance, it's always better as a seller to be measured on turnover or gross profit rather than net profit, because it's just too open to manipulation otherwise. So, there's lots of things to be aware of and to guard against. It's about supply and demand, isn't it, Chris? I think if you're running a business and it's maybe more of a declining market and you haven't got as many opportunities to exit, and you've not got the energy or the enthusiasm to carry on either addressing the issues or making the investment, you're probably going to be more inclined to do something which sees you get more jam tomorrow and less on day one if there's that opportunity to see a greater capital return in the future. But if you're sat in a really great business, which is ticking over very nicely and actually doing even better because of COVID maybe, and has responded well to the challenges, you're going to be sticking to your guns.
I launched a boutique PR company, an events hosting business 2 years ago. If you can get me 10 million for that, Keith, the money's yours. But when a business sits down with you at the moment, virtually, I would think, and says, I want to sell my business, what do you say? What's the starting point for that company?
Well, look, I think our role is to, first of all, if you're going to be a decent advisor on a transaction, you need to completely understand what it is you're doing, what it is you're selling or buying. So you need to understand as much as possible about the business and what it does, and understand who the key people are. Understand why, if it's a sell side piece of work, why is the shareholder selling, what they're looking to achieve? Is it with a view to a partial, it's like a cash out and a rolled equity situation where they sell to private equity, but then they look at growing and then going again in a few years' time, making an even greater return? Or is this a once in a lifetime disposal, where it's just really around getting the best possible price, cash out on day one? I think you need to understand and make sure there's a decent team in place around you. So, I've been talking about multiples and all the rest of it, but that's more the role of the corporate finance advisor. And it's making sure there's a decent corporate finance advisor on the ticket for a seller to make sure that they can find the right buyer and they can understand, what looks like a decent price for that for the seller in terms of, negotiating what is maintainable earnings, what is a decent multiple. And getting a good tax advisor on board as well. So I think you understand all that. You understand who the potential buyer might be. Is it like to be a PE sale? Is it like to be, a trade sale? And then you can start to advise. And the things you need to be thinking about, I think, as a seller are, first of all, do you have the right management team around you? One of the advice you often hear to sellers is you almost have to try and make yourself indispensable in many ways if you're looking to properly retire, because the buyer, if you're too key to the business, is going to be less keen to pay the price without that sort of earnout arrangement. So incentivizing a strong management team around you, thinking about maybe share option schemes, a tax efficient way of giving them some sort of capital return, sharing the reward is good. Think about, are your staff engaged? We actually do work with Palatine, actually, helping with due diligence into staff engagement in target businesses. It's not just about who the staff are and how much they're being paid and so on, but what's the culture like within the business, because that's increasingly important in people businesses. We talk about the need to iron out wrinkles, obviously try and settle litigation, try and settle any sort of inquiries with HMRC and so on. Just make it as clean a process as possible, make it as easy a process as possible for the buyer. and formalize contracts, tidy up your share ownership, just sort out your housekeeping, because at some stage sometime soon you're going to get a big long questionnaire from a buyer's lawyer, which you're going to have to answer. And the more information you've got at your fingertips, the quicker you can populate that data room, so then the information's all there ready for the buyer to review. You find out all your problems and away you go. And I think if you can address that, get decent sound financial reporting systems in place, so the raw financial information which the buyer is going to look at is strong and it's robust. And then also look at maybe stripping out any sort of non-core assets. So, we've seen deals where, you've got boats and planes and residential property target companies, and that's the sort of thing that just holds things up. And if you wanted to make a transaction smooth, which, to go back to the earlier point, is all about making a transaction as smooth as possible, then and it's an easy process for the buyer, then just address that sort of stuff. But those are sort of the things that we really sort of focus on, I think, at the early stages.
Just thinking about something you said there, Keith, and it brought back many unhappy memories. I was once told by a former employer, Chris, the key was to make myself replaceable so I wouldn't be missed. So I made myself replaceable, so they replaced me.
It's always important to also own all the shares in that scenario.
Absolutely. And I didn't own any. Obviously, it's important from your point of view to try and get some competition. So, people there's more than one interested party in buying a company. That's a given. Having said that, where's the interest coming from? Are you, for example, seeing much overseas interest? Is the US opening up its purse strings?
Well, the US buyers have always been a feature, I guess. Since I've been doing this, and I think when the pound was at a relatively low level, then obviously it was cheaper to buy your assets in the UK, and I think that that'll still continue to be the case. So the overseas buyers, yeah, absolutely. I mean, just to give you an example, I know in particular we do some work in Cumbria. We do quite a few transactions buying and selling businesses in the hotel sector, for instance, and that's very much an attraction to overseas investors from all over the world, really. So often you'll see lots of interested parties from overseas buying up the hotels and the lakes, because obviously it's a captive market, and at this stage of the game, when you can't really go abroad at the moment very easily, then for this coming summer, at least the hotel sector in the lakes is looking fairly buoyant, I guess. You've got obviously your standard trade buyers, PLCs, need to satisfy market expectations to grow the margins, improve the share price. We'll look at acquisition activity always, and as Kieran on that talk about private equity and PE-backed businesses are looking for bolt-ons to achieve an exit. There'll always be an interested bidder. The other route we're seeing a bit more of, and I don't know if other people have seen the same, is a move towards more employee ownership trust deals. So just teaching people to suck eggs maybe here, but an EOT is quite a tax efficient way of an owner exiting a business. The idea is you basically create a trust company and you sell your shares effectively back to your employees. And as long as you divest of a controlling interest and you meet certain other criteria, currently the tax rate on that for a seller is 0%. Capital gains tax. So that's obviously an incentive for many people to do a deal, but the downside is obviously the company's almost paying for itself in a sense. So usually the day one cash payment is really whatever excess cash is on the balance sheet. You might be able to borrow some money from the bank, but normally as a seller you're then waiting for 5, maybe 10 years for payment off in full of all the purchase price. But at 0% tax rate, that's quite attractive for many people.
Yeah, JJO did that recently. Stephen Greenhouse, who I know very well, and they did that deal. So thanks very much, Keith. The best speaker we've had so far by a country mile. I'm going to come to thank you. I'm going to come to Kieran Lawton now, Senior Investment Director with Palatine. Kieran, how are you?
I'm very well, thanks, Chris.
I look at you. I look at you now, Kieran, and I think to myself, you know what? You've got that familiar look, like I've seen you before. Has anyone ever said to you that you look like anyone famous?
Yes, as you well know, I have a number of very poor lookalikes. That's understood.
Go on, just name a couple.
Crikey, they do range. So Michael Barrymore, I've had that a few times. And interestingly, his middle name is Kieran as well, which doesn't help. Ranges Screech from Saved by the Bell, which is one for a certain age of viewer. Sliced Alone I've had before, which I think is because of my incredible physique. Crikey. Oh, John Cusack. I've had that one before.
John Cusack.
And because of John Cusack, I also get Joan Cusack, his sister, who does look a bit like John. So yeah, a myriad of faces there, Chris.
No one's ever said you look like a famous darts player called Phil Taylor.
Oh, only you, mate.
Only me. Listen, rather, we're going to move away from lookalikes now to talking about deals, because that's an area that you're much more familiar with. I know Palatine very well, but just tell us what you do and what Palatine does.
Yeah, so Palatine is a mid-market private equity house. So it was established circa 15 years ago, and we invest in what we term the lower mid-market. So tends to be businesses doing 1.5 million plus for our impact fund, which is one of the funds we invest from, and circa, circa 3 million EBITDA plus from our buyout fund. We are investing from our fourth buyout fund and our first impact fund, which I might talk about a little bit later on. But yeah, so sector agnostic, we invest across a range of sectors. Historically, we've done an awful lot in financial services, TMT, business services, consumer, but we invest across a range of sectors. It's more about the team, it's more about the quality of that team, the market in which they operate, and the potential for value creation. And just on that latter point, just to touch on that, what we really look for is probably three things. So buy and build acquisition opportunities. About 80% of our portfolio has followed that kind of remit, that kind of plan, and we're good at it. So we like those opportunities. Opportunity for value creation through operational improvements, and that's really just helping the business scale up. We have an in-house operational support team who can help people do that. And then finally, ESG, so environmental, social, and governance. That's like it's an oft used phrase these days, but it's of paramount importance to us and has been since inception. We take it seriously. We see it as it's the right thing to do. So it's a value creation initiative, but it's also not just what you do, but how you do it. That's an intrinsic part of Palatine as an organization and also in the businesses that we invest in. And that led to us raising an impact-focused fund a couple of years ago on the back of our ESG credentials.
And what sort of amounts do you invest in?
Impact fund will invest typically 5 to 10 million of equity. The buyout fund circa 10 to 30. We can do more than that out the buyout fund if required. And we can also co-invest across the two funds. We have done that just recently on a deal, but typically it's 5 to 30 million, Chris.
I'm just looking at the comments. Ian Round has just posted a message to say, I agree about the increased popularity of the employee trust. Proud to be involved in the JJO deal. How did COVID affect your sector at the time, and 1 year on, how is it affecting it now?
At the time, I mean, Keith's right, it was very reactionary, right? So I think, we've got a portfolio of 20 odd businesses across a range of sectors, as I say, and some were impacted more than others, but everybody was affected to some extent. I think, look around March, April time, I think everybody was basically tuning into the news at 6 o'clock to hear Bojo say what he's got to say that day and then reacting the next day. There wasn't an awful lot you could do in terms of planning ahead because nobody knew what was happening the next day, let alone the next 2 to 3 years. So what was encouraging from our point of view is how our management teams reacted at that point in time. And to a team, I think they came across really, really well. It was basically trying to understand what was going on and how that impacted your own business. But it became quite insular for quite a short period of time because there wasn't a lot of opportunity to do anything else. If you look across our portfolio, that's why you have a portfolio, isn't it? We've got travel businesses, mortgage brokers, hospitality businesses who are all clearly impacted massively and very, very quickly. And then you've got others that perhaps weren't impacted as significantly from a trading point of view, but it still has an impact, right? And you still don't know what's coming. The uncertainty was what was difficult to manage, but the teams did that well. If I look at so I sit on 4 boards, Chris, right? And I think it's probably an interesting microcosm of the situation. 2 of them are in hospitality. So I sit on the board of Gusto Restaurants and the Alchemist Bar and Restaurant. Both of those went from being good businesses to generating nil income and some costs. That's not a great business model for anyone. And that was hands to the pump. I'm on the board of a business called Zyro Fisher, which is a distributor of cycling parts and accessories. Cycling shops, as you'll be aware, were one of the few things that remained open during COVID, and actually that business has benefited from COVID. Another one called Lucian Services, which is a testing and inspection business in hazardous materials. The only way that was really impacted, mate, was through being able to get people on the ground to do some of the testing. But fundamentally, it carried on trading and actually generated a fair bit of cash over that period. So I'd say that, just in summary, in the early days, it was very reactionary. Then there was a period over the summer where a lot of our teams, quite rightly, took stock, looked at their business and thought, okay, this has changed the dynamic somewhat, but how can we use it? How do we come out of this lockdown period a better business? Just by way of an example, one of our companies was looking at a 20,000 square foot office in February. Didn't happen. They then looked over the summer and thought, well, hang on, what if we took a 10,000 square foot office? They invested the rest in technology, because what we found is our clients, it was kind of professional services, our clients are quite happy doing virtual meetings rather than coming to an oak panelled room in London somewhere. So I think it gave senior teams the ability and the time to think and take stock and look at how their business could be improved. I think beyond that, Chris, look, it's another factor to be considered in running a business. There's a limit to what you can control, but I think the more certainty that comes, the easier it is. But it's just another thing to be considered in growing a business. You can't sit there for 2 or 3 years waiting for this to all bed down, otherwise you'll be lost. So I think the encouraging thing has been how the teams have reacted and kicked on post that first tough period.
We're doing this event remotely, like most events at the moment, like all events at the moment as well. But in terms of doing deals, you're not looking at people, you're not seeing the whites of their eyes face to face, are you? So the deals that you're doing, how is that sort of impacting? How is COVID impacting on that? Because presumably you're not meeting the teams.
We're not meeting the teams early doors, right? So I think this is the hardest bit about the deal. So we back management teams. The part of the market we are in tends to be privately owned businesses, entrepreneurs, and fundamentally, you are backing them to deliver a plan. Now, we've done a number of deals over the COVID period, which I'm sure we'll come back to. Personally, I find the difficulty is, as you say, looking in the whites of the eyes and actually trying to build a relationship when a lot of the access you're having is virtual, in a group setting. And that's vice versa as well. So similarly for a management team, I think it must be difficult to get to know the buyer as much as they should do, and that is an important factor. It's often an emotional decision, and one that the people factor is a big one. I think how it's managed, there are pluses to it, right, Chris? So I think in the early stages of a deal, you can actually get through from a seller's point of view. I think you can meet a lot of people quite early on. It's a lot easier logistically to manage than waiting for so-and-so to be available to come up from Birmingham and so-and-so from Scotland or wherever. So I think in the early stage of a deal, I think it's quite useful. I think it's also useful for smaller group settings. Again, to try and establish and build a relationship. Personal view, though, is we wouldn't do a deal without meeting the team. I can't see how that is a good thing to do. So
you've just put yourself on mute, Kieran. Kieran, you just put, and to be honest with you, nobody noticed.
It says the host put you on mute. How rude is that?
Well, I mean, there's a technical host. I mean, I'm only acting on behalf of what people are asking me to do, Kieran. But it's more interesting.
You start off saying I look like a fat darts player, and then you put me on mute.
Well, to be fair, you're the one who said you look like Michael Barrymore, and we're not going to go any further forward on that. One thing I was going to ask you, and it's a question that's come from Ian Rown. He asked Kieran, he said, are your funds Northwest based or are they national?
National, so we invest across the UK. Headquartered in Manchester, we have offices in Birmingham and London as well. But now we're a national.
And you've closed 3 deals in the last 12 months. I think you've done 3 bolt-ons as well. So deals are clearly getting done. How would that compare with a normal year, Kieran?
Typically, from buyout fund point of view, we'll do 2 to 4 deals a year, and that's similar for impact. We've done more than that, actually. So we've invested in a core and IT managed service businesses just before lockdown. It's quite interesting that because we underwrote the debt, so we took on the debt and the equity with a view to refinancing it immediately afterwards, and then lockdown hit, and that was a bit hairy for a minute, but we managed to refinance that. So that was done. NRG, fleet management business, we did back end of last year, and Thesis, environmental consultancy, which we did with our impact fund quite recently. Transcript, which I'm sure will come up again when Paul talks, pharmaceutical services business, Back to Work, a training business, Easy Fundraising, a charity reward shopping business. So you look at that across the 2 funds, Chris, we've done exactly what we'd expect to do in a 12-month period, which I think is brilliant, actually. We're delighted with that, given what's been going on. On top of that, we've done bolt-ons for CET, Ren Sterling, Sunterra, in exclusivity on one with Lucian, and we're also in exclusivity on another deal, a new transaction, which is progressing at the minute. So look, from our point of view, look, it is difficult and it has been different, but there are still people who want to sell their business, and there are still buyers out there who want to buy businesses, and you can still make that work. It goes back to my point around, you get to last summer, there's it's similar to Brexit, right? You could sit there and wait for Brexit to sort itself out, but you can't. We're a fund with a 10-year life. You can't just sit there and wait for what you think might be certainty. So from our point of view, you look at the risks and rewards associated with that and make a decision accordingly. But there's still activity.
Yeah, I mean, I was just, most private equity houses would presumably work on like a 5 to 7 year cycle. So are you having to sort of, I don't know if you've got to a point where you were looking to exit, where you're just having to kick the can down the road for another year or two, or do you think the time that you stay vested in a business will be longer?
I think it's fair to say a couple of potential exits were put on hold just because the timing wasn't right. Having said that, I mean, we exited Vernacare, a healthcare business, just before lockdown, which I suspect has gone quite well for HIG because it had a kind of sanitary products side of the business, which has probably done okay through COVID. But has it impacted on delayed sales from elsewhere? Yeah, it has a couple of them. But to be honest, Chris, that's just part and parcel of it. If the time is not right, the time is not right. I mean, for example, Alchemist is a cracking business, and it will be when it reopens again. But would we look to sell it in the current environment? Absolutely not. So yeah, we might hold that for another couple of years. I think with people get hung up on the time scale, Chris. I mean, it can be, typically we look at 3 to 5 years when we're originally looking at a business. But we sold Wesley within 18 months, and we've sold other businesses for after 8, 9 years. It's got to be when the timing's right for the business. Typically, you want it to be 3 to 5 years. That's fine, but plans change, and I think as long as you have the team and the capability to adapt accordingly, then you do that.
I was talking to Steve Oliver yesterday. He's a fantastic guy at Music Magpie. I mean, they're in the press at the moment for a potential IPO. Do you think we're going to see many flotations this year?
I think the IPO market is potentially quite interesting, actually. There's more of it happening. I've spoken to a few brokers in the last couple of months just to get a feel for what they're seeing and doing. And I think the interesting thing from our point of view around the public markets is their view on the future. So if you take hospitality, for example, restaurants, bars, clearly that is a sector that, well, don't get me started. I think it's been treated absolutely abhorrently by this government, but that's another matter entirely. But it's on its knees, that sector. However, if you look at listed company multiples in that sector, you've got you're talking at kind of the trading at 8 to 10 times EBITDA. Now, what that EBITDA is another matter because it's kind of made up at the minute. But the point is they are pricing in a future resurgence. You've had Hugh Osmond floating a vehicle. You've got Sarah Bellingham floating and making an acquisition. You've got Rooney Anand raising a vehicle to go out and buy pubs. So the point I'm making is in a sector that is struggling, there is capital being invested in it. And I think that's quite an interesting sign. If you then look at, there's a lot of e-commerce businesses being floated, a lot of tech businesses looking at it. I think it's a viable route for certain businesses of a certain size. So yeah, I think that'd be quite interesting over the next 12 months.
Okay, all right, it's Kieran. Thanks. And how's the throwing arm? How's the?
All right, Steve, go.
It's the way you pursed your lips there, Kieran. I'm a bit worried about, but right. So we're going to come
out of Blackpool.
going to come to Richard Robertson, corporate partner and head of Napthens in the East Lancashire corporate team. Richard, little known fact about you, and tell me if I'm wrong in this, but my research tells me that you had a part in a Bollywood movie. Is that right?
Yeah, it won't be a surprise to anyone who's seen me dance that, Chris, but that is true. That is true. There's parts of the subcontinent where I'm still not safe to go to now, get mobbed.
You were an extra.
I was an Australian doctor with my wife when we were travelling. We had a speaking part. She was gutted, but yeah, I think I can't remember what my line was. It was someone had been in a car crash, but yeah, I'll try and dig the YouTube video out somewhere. But yeah, different life.
Thanks for spending some time and speaking to us. It's I feel blessed. Actually, but we'll come back to it. Come back to the answer. But Nick Stafford asks, what about craft breweries' future? So there's a question that hopefully you can provide some insight on. But Richard, you joined Napthens 7 years ago from Addleshaws, and you work out of Blackburn. Would you say you're more important to Napthens than Keith Melling?
I'm certainly better looking, but well, it's interesting actually. That partnership with Keith said has just been great for us. So no, I think we've become symbiotic. Is probably the answer. So that sort of partnership across the firm and with clients has been really one of the keys to our success. So I am based in East Lancashire, but as Keith said, we've never really been based anywhere. We've just had a place where we go to work, and we've followed the work and the clients, and that has become even more so now. So I'll let others decide who's the most important, but we certainly work together a lot.
Of course, that's me being facetious and hoping I get a nibble, but far too diplomatic. But I would expect nothing else from a super Bollywood film star like yourself, Richard.
The media training kicking in.
Would it be fair to say, well, that's because Gillian Savills on the call, probably watching right now, thinking he did well. Would it be fair to say, Richard, that you're doing more sales side work?
Traditionally, I think Napthens has probably done more sales side work. Certainly, when I joined, from the background I was, where I'd been mostly buying stuff for large corporates, there was a sort of desire to try and shift the mix a little bit, and we've been quite successful at that. So, yes, traditionally we've done a lot of sales side work, but as our sort of reach has grown and people have become more aware of our skill set, we have increasingly got more buy side work, larger clients, but it's probably a sort of 60-40 split in favour of sell side, I suspect, in our business. So we're pretty experienced in dealing with the family business, the owner manager. We've got the skill set to take them on the full journey now. Perhaps sort of 10 years ago, Napthens would have probably been a little bit more traditional, but certainly dealing with the likes of Kieran and others and those worlds is familiar to us and our people. So we can take a sell side client through the whole sort of panoply of options, really. But yeah, more and more buy side since I arrived.
Yeah, we've had a couple of questions. I'll come back to those when I've interviewed the four speakers. Has COVID made it more difficult to accurately price a business?
It depends. There are some businesses where we're seeing people struggle, if I'm honest, because, and it can be put both ways. Some businesses have done really well, and some buyers are trying to work out, is that a blip? How do you normalise the last 12 months? So yeah, I think it can be a difficulty. We've had some deals have gone off where sellers have taken a certain view on what the future looks like and the impact of COVID, and buyers have perhaps taken a different view and said, perhaps we'd just like to look at this in 12, 18 months' time, where we can actually try and assess the impact. So it has had an impact on a lot of businesses, but similarly, there are some sectors, as Kieran said, where actually it's been great for them, and people have seen that change and think it's going to continue. Certainly in tech, we've had quite a lot of tech businesses where actually just people are looking at the opportunity more than the performance. And we've had a couple of transactions where actually, if you applied a multiple to it, it would be off the scale, but it's actually more about the strategic fit. So it's a bit of a mixed picture, but we have got challenges in some transactions where people just can't model the last 12 months. And it depending on the buyer, some of the guys can't get to the approvals process because of that difficulty.
You mentioned earlier, touched upon by the other people, that multiple very much depends on the sector that you're in, especially at the moment. We've spoken a little bit about the impact of tech on the deals market. And one thing that's interesting, of course, is that you're doing electronic signatures now on contracts. How has COVID changed the process of the deals market? Is it much more, one step removed? I've got romantic images of deal makers with their sleeves rolled up to their elbows, in a deal room until 2 o'clock in the morning, and then fist pumping when the deal gets over the line. The reality is probably slightly different to that.
Yeah, it is now. I mean, when Kieran and I used to start out, that was very much, a big part of it, and it was quite macho. I did a deal a couple of Fridays ago, and we sort of had the completion call, and everyone was sat there, in their pajamas almost, with a glass of wine, and it looked like, we just sort of cut to EastEnders or something. Everyone's sitting in the lounge having a chat, and that has changed. I think, especially the legal sector, we never like to be at the forefront of technology because the risk of it going wrong is potentially devastating when you're dealing with highly sensitive, confidential information and actually getting a process done. So at the start of lockdown, we completed a deal, and we ended up having people driving around the northwest of England to get signatures at 2 o'clock in the morning, because we weren't quite set up. The deals we've done lately have just been very smooth using electronic signatures. And everyone now gets it, the process, the lawyers, the advisors, the clients, everyone has switched to that. And I think that will continue, because for certain transactions, it's a much better, more efficient way of doing it. The time and the cost of printing stuff out, setting documents out in boardrooms, it has a place and will have a place. But I think that the whole market has over the course of the last 12 months really adopted different ways of working, and that will continue, I'm sure.
Yeah, I think there's going to be a hybrid moving forward. I read a statistic that insolvencies are down to a 2-year low. I read that in February. Do you think the M&A activity will continue when the furlough period ends? Because there is a train of thought that says when the furlough period ends, we'll see a spike in insolvencies. Do you think that'll have an impact on M&A?
Well, yes and no. I mean, I think, don't forget, insolvencies are deals. There are distressed acquisitions. Often insolvency might go either way. So I think the difference, and people try and find comparisons, don't they, to previous recessions or previous economic difficulties. The difference here is liquidity. So unless the government continues to support those ailing businesses, given the liquidity in the market, it's inevitable that there's money around to allow insolvencies to go through a process. Post 2008, no one had any cash, so you couldn't actually get things through an insolvency process. So I think it's inevitable from the lows that they're at that insolvency work will kick up. I think that's probably quite healthy. It'll give distressed businesses an exit out of that purgatory, and maybe they can be reinvented. Will that impact M&A? I think the M&A market will still be strong. It may be a bit lumpy. There have been some drivers, pent-up demand, threats around capital gains tax. But as Kieran said, there is a resilience to this marketplace, certainly to this part of the country, and people will not sit around. And where there is cash and there is opportunity, there will be transactions. Add to that the mix that I think some of the CGT fears haven't gone away. We've got clients who are looking ahead of the next budget, just because clearly we're all going to get taxed more for the next however many years. So I think the M&A market will stay. Will it be as crazy as it is at the moment? Personally, I wouldn't mind it cooling down for a couple of months just so we can catch our breath. But I think there will be continued activity on both sides.
We're here to talk predominantly about COVID, of course. We've not really touched upon Brexit. Is Brexit having an impact on the deals market?
Brexit's back, I think, officially. And I think one of the things leading into this pandemic was that the market had got used to Brexit, and we were I think most of us felt we're on the cusp of actually just getting back to some kind of normality, and we were just pressing on. COVID impacted that, obviously. Yes, people are now focusing. Post 31st December, the reality has been, and there are real difficulties in terms of moving goods around. We did a webinar on it a couple of weeks ago, which I hosted, and there are some really challenging stories in terms of how you can move your goods around. Rules of origin coming in as well will mean manufacturing businesses have got some real challenges, and we're hearing, even only yesterday, around some of the politics going on about supply chains to do with vaccines. So Brexit's back, and I think it will be probably something that we'll be talking about a lot more, certainly at an operational level. Will that impact the market? We're actually seeing quite a lot of activity from European buyers into the UK. I've got a number of transactions on with Germans, Scandinavians, and others. And similarly, clients are still looking to Europe to try and get a foothold in there. So I think Brexit's back. No one has got any answers from what I'm seeing to the difficulties. We've just got a long haul there working out what we do, but it's going to impact certain sectors.
Final question before I come to Paul McClusky, is that how important is it for sellers to keep their eye on the prize and not be distracted when embarking in the process? Because it's very easy sometimes when you're trying to sell your company that your focus is 100% on that, and then you can take your eye off the prize.
The honest answer is it's impossible not to get distracted. So going back to Keith's points earlier, the more prepared you are, the better the process will be. So, resources challenging. Most sort of SMEs do not have in-house legal teams and, M&A teams. So inevitably, management is going to get distracted. So it comes back to the point Keith raised earlier, really. The more prepared you are, the more organised you are, the smoother the process will be. But you're right. The last thing you want to do is take your eye off the business that you're selling, because inevitably, people will look at your last quarter's numbers, and if they've dropped, there'll be some questions to ask. So it's really important to be focused, but at the same time, it's impossible not to get distracted. So get people around you that can help, that can guide you, and get them around you as early as you can. And, it won't stop it happening, because it inevitably will, but it'll make it a damn sight easier, and it will hopefully make the process shorter and cleaner. So, a lawyer would say, get your advisors in place. But I think Kieran and others on the call, Paul, I'm sure will say the same thing. Get the management team right, get your advisory team right, get them in place early enough that they can actually influence it. There's no point ringing them 6 weeks out from a deal, because all they can then do is just try and, help you put out some of the fires.
I'm going to come to Paul. We've had some questions that come through. I'll be asking them at the end. So Azim Khan, Medina Barker and Paul Nichols have all asked a question on the Q&A. We've also got a question from Nick Stafford as well. So if the panel want to just have a look at those when they think how they're going to answer them. Paul, I'm going to come to your good self. You've just become the chairman of a Palatine portfolio company called Transcript. Am I right in thinking that you act as an advisor to Palatine on all things life science?
Life science and healthcare, yeah, but not exclusive to Palatine. I probably work with 4 or 5 private equity houses in the Lawton mid-market.
Yeah, and I want to take you back to March of last year when Boris Johnson made that first big lockdown announcement. You were, I think at the time, you just retired as an exec, and suddenly there was this big announcement. What thought process went through your mind at the time?
If I'm honest, probably that we just entered some kind of disaster movie. I remember the guys in the hazmat suits at the hotel in York putting the first 2 people with COVID into a special care unit in the infectious disease unit at Newcastle Hospital. So I thought we were heading into something that was going to be very, very, very scary. And I think it's been very scary on a social level, on a healthcare level. But as far as business has been concerned, Chris, I think it's been surprising that we had a lull that everybody's talked about, where we had to understand liquidity, we had to understand what we could and what we couldn't do through COVID. But I think what's been clear is that consumers still have confidence, business still has confidence, investors still have confidence, and that 2 or 3 year trough that I thought was going to happen, where where things were going to go really, really quiet, it hasn't happened. And as Kieran's articulated, there are sectors that are just going to have to take 18 months out, 2 years out. That's and they're still going to need some support somehow, but the rest of the economy is still moving on. What happens in 3 to 6 years when we start paying for it is a different matter.
I mean, you've been involved in 3 private equity transactions since the start of the pandemic. Is that a typical year for you? Is that a quiet year? Is that a busy year?
I think generally, deals were down last year, and we're talking about a second half where we've all been rushed off our feet, but still the second half of 2020 was a quieter second half than 2019. I think, though, it's been busier in the space that I specialise in, which is life science and healthcare, because it's one of those resilient sectors. It's got sustainability, it's got cash flow. So it's pretty much like TMT, business support sector. There's a lot of appetite from buyers in those three particular spaces. So I've generally been quite surprised at how busy life science and healthcare has been in the last 6 months.
Yeah, I mean, just looking through the list of attendees, yeah, I got a good friend of mine, Andrew Kerry from Seneca Partners. He's on the call today. Obviously, no doubt, getting over Blackburn's very successful 0-0 draw yesterday. They focus on the bioscience sector. They're very big in tech as well. You know, healthcare and TMT have proved popular sectors as well. Is there a lot of competition from interested parties for those assets at the moment?
Yes, and I think some of the competition that you look at is there's almost a view that says we must look at this because it's in life science and healthcare. We must look at this without actually understanding the investment proposition first. So there's an awful lot of activity at the before you get into the process. You know, at kind of the teaser kind of level. There's a lot of people trying to work out is this an investment? Is this a business? Is this a management team that private equity want to support? And there's been a few businesses that have looked at with people, and you really say, well, why are you looking at that? And simply because it's in healthcare, and that is breeding an awful lot of competition and a lot of interest in the space.
When it comes to selling a business, Paul, it would be very easy for a company to say, well, you know, our bottom line was being affected by COVID, etc., etc., etc. If you want to sell your business, that's not going to cut any ice, is it? That's not going to cut the mustard, because they're going to want to see a lot more than just an excuse.
Yeah, I mean, the days, I guess, of presenting a couple of charts that show last 2 years history, and then a hockey stick going up after the investors come in on revenue and EBITDA. I think that they're definitely gone. If we think about it, COVID must have affected 99.9% of businesses in the UK, one way or another, either positively or negatively. And that's not an issue that anybody in business could have done anything about. But what business managers can do something about is how they react to COVID. So the decisions and the thought process that they go through with their supply chain, with different sales channels, with how they've managed their staff, how they've managed technology, how they've managed liquidity, how they've refocused their cash flow forecasting, etc. And I think if I was looking to sell a business myself in 21 or 22, I'd be going back to this time last year, and I'd be looking at my MI, my board packs, and I'd be trying to work out what were the decisions that we took as a management team. And I'd be articulating that. What was the decision? What do we do? How do we do that? What's been the effect on the business? So I'm not saying restate numbers or anything like that. I'm actually saying try and work out and articulate what this great management team have done to sustain the profitability, to enhance it, or whatever, because that's going to be the driver in confidence for post-deal. That if an investor can see this is what you've done and this is what the impact has been through 2020, through 2021, then there's the confidence for 22 and 23. And in a way, it's a huge selling tool, I think, for management to be able to articulate that.
Whenever I do events like this, I always try and find out something about each of the speakers that maybe the audience doesn't know, because people would tend to remember that. You know, Alistair McGowan, incidentally, Kieran, Lawton, somebody else you look like. Definitely, that's another one on the list. Yeah, I was just thinking, Paul, though, that you know, one of the facts I heard about you is that you've never ever bought a coffee from Costa Coffee, Starbucks, Caffè Nero. You've never bought any of that. So is that a metaphor for the way like private equity and buyers look at potential targets? You're not interested in overhyped, overpriced, frothy businesses. It comes down to the basics. That's what excites you.
It's probably more to do with the fact I'm just tight.
You're from Yorkshire, aren't you, Paul? You're from Yorkshire.
I'm from Yorkshire, yes.
That's all we need to know. Yeah.
But I like to think of being a missionary in the Northwest, Chris, since 2005.
Yeah.
Yeah, in a way, yes. I mean, private equity will cut the froth away. You know, we'll get the basics. We'll look at value, but if there's a different way of cutting the deal, and I think Kieran alluded to this, if there's a different way of restructuring a deal to get the right value at entry point, then private equity are the best at restructuring a deal. I guess in the whole, you know, you can go into use the analogy, you can go to a coffee shop and think that something's overpriced. But what private equity really spot on at is understanding the longer term value of that cup of coffee. So to me, it's a tub of hot water that costs £3 or whatever. But what you need to look at is what satisfaction you're going to get from that. How are you going to enjoy that? How long it's going to stay warm? All that sort of stuff. So the equivalent in private equity is, yeah, there's a price. Yes, there's a management team. Yes, there's a structure. But really, it's how you're going to create value over that investment period, and where the business is going to go to, and how you're going to exit from that, and where the associated risk is as you go through. So in a private equity environment, you may well pay £3.50 for a cup of coffee, Chris, and enjoy it, because it'll give you that value at the end of the drink.
Yeah, well, I won't actually. I'm more of a Greg's man myself, Paul.
Yeah, good.
And I take a recycling cup here as well, so I get 10p off. As do you, Paul. You've probably got a stove in the back of your car, haven't you? You just probably heat the water up yourself. Are we seeing now, because there's a lot of money knocking around at the moment, do you think you'll see a lot more business owners wanting to sell because the experiences of COVID have made them realise that actually it's a fickle world out there, isn't it?
I think a lot of business owners are going to reevaluate their strategic objectives. I think when people come out of COVID, they're going to be exhausted, and it's an opportune time to reflect on longer term strategy. So there may well be an opportunity for businesses to sit back and reevaluate things. That might mean a pure sale. It might also be an opportunity, given liquidity and given investment needs, it may well be an opportunity to bring in a minority investor to support the business's growth. It may be an opportunity to bring in, more experienced, larger management structures. When you think about the pressure that CEOs and management teams have been under in the last 18 months, it's still continuing, and it will continue. It's only natural that you have to think, am I going to de-risk? Am I going to bank what I've earned? Am I going to look for help in terms of providing finance? So I'm pretty confident the next 18 months are going to be pretty buoyant from a transaction perspective.
The final question before we open it up to questions from the audience. We had a couple of questions from Nick Stafford in the chat facility and 4 questions in the Q&A. A phrase that you're starting to hear a bit is continuity planning. It's a sort of phrase that people would roll their eyes at maybe 12, 13 months ago. Do you think companies have got to factor in continuity planning now more so than ever? Yeah.
Continuity planning, disaster recovery, whatever you want to call it. When I've been running businesses, I've done exactly what you've said there, Chris. I've rolled my eyes. How can I put a plan together for something that I don't know? How can I plan for that? And you kind of go through the motions a little bit, and I've been as guilty as anybody with that. You can't plan for COVID. You can't plan for the next event, because by definition you don't know what the next event is going to be. But whether it's starting to look at making sure that you understand how you can source supplies, how you can manage flexible working with your staff, your IT, even to the point of making sure that your business continuity plan has contact numbers for people in it who are still alive. You've got to keep it relevant, because that is going to be one of the key things that investors are going to look for. Investors have themes, and themes in the next 6 months, 18 months will be around flexible working, around IT, and around business continuity. And if you can't articulate what your plans are, then you're going to struggle. And the other relevant point is, I also would believe in the near term that the insurance market will harden up. So, at the moment, insurers are paying out a ton in terms of business interruption. That won't continue. So it really is dependent on management teams and sellers to have a clear understanding of their continuity plan, Chris, and to test it and evidence it.
Okay, I've had a question from Nick Stafford too, actually. The first one, I can't offer any insight. I just Googled it to see if I was missing something. What about craft breweries' future? I don't know if anybody knows anything about that. I've just Googled it. They seem to have quite a good time at the moment. And Nick also asks, how small a business will private equity look at investing in? So, Richard, if I come to you on question 1, and I'll come to Kieran and Paul for question 2, can you offer any insight on the question about craft breweries' future, Richard?
Hi, Nick. How are you? Well, yeah, I think it's interesting. That sector we know quite well, as Nick knows. And of course, there was a period of time not so long ago where multiples went out the window, and a couple of deals happened, and everyone with a tub of yeast thought they were going to be selling out for billions and billions of quid. I think they've used that yeast to make bread over lockdown. But so Nick, I think the market's been challenging. But what we've seen, and you'll be very familiar with this, is how that market's adapted and how they've gone into new sales channels. So I don't think I've got any particular insights into how the sector will respond. But what I will say is that that market has been strong, and the way that that market has reacted has not done anything to challenge those assumptions. So I suspect, Chris, for the right products, as before, the large distributors and sales channels will continue to keep an eye out for that, because that market has been successful. Interesting to see how the smaller breweries have perhaps changed their sales channels, and Nick will know much more about this than me. But I've been really impressed with how some of those smaller breweries have been agile and found new routes to market, which I know in that sector can be a challenge and can be a little bit of a hurdle for people to crack on. So I suspect Nick knows the answer to this question better than me. And maybe we should have a separate webinar, Nick, where we can get you and people in the sector, because certainly your products have helped me get through lockdown. Keystone Warhammer, I've really sort of been drinking most of lockdown, as anyone who looked down at my shirt when I moved out of shot will see.
Okay, too much detail there. I'm worried you've got nothing underneath the shot. So Nick says, very helpful, thanks, keep drinking. Nick also asks, how small a business will private equity look at investing in? Kieran, do you want to answer that one for me?
Yeah, sure. But just to follow on from what Richard said, he's spot on. I think for any business, what differentiated? That is a very competitive market, but what are you doing different? What's your product quality? What's your brand strength, and who you're selling into, and how does that get affected? But just to answer the question on size of private equity, I'd probably turn that around another way, Chris, and say, well, what are you looking for investment for? And I think that needs to be really clear. Are you anyone can write a check, so if you're just looking for some cash, that's fine, but what are you looking for from an investor? And that will then dictate what your options are in terms of where you get funding from. Private equity, I mean, we would invest in a business that, as I said before, made less than 1.5 million EBITDA, but that's just the way our fund is set up. There are smaller funds that will invest in smaller businesses and larger funds that will invest in larger businesses. However, private equity isn't the only option. I mean, Keith described an option earlier. Private investors are another option. Smaller funds, institutional funds, or VCT type funds. If I were an owner of a business and I was considering my options, to touch on what Richard said earlier, he's not wrong. Speak to people who know about it. I think anyone who's even considering cashing in part or all of their chips should be speaking to someone who knows about it. Get an advisor on board, see what they think, consider your options, consider what you want from an investment. Is it just money, or is it support, advice? Do you want to grow the business? Do you want to exit? There are so many questions. Get an advisor on board and talk it through. And then if you are considering private equity, I used to say this when I was an advisor as well, and I'll say it as a private equity investor, meet 4 or 5 of them, because we are all different. They all have different styles, different personalities. And if you are taking private equity on board, or any investor for that matter, you're going to be working alongside them for a considerable period of time. And this is a big decision. It's a two-way process. It's not just us saying, yeah, all right, quite like look at that, is 10 million quid. You know, you've got to work with these people for whatever, 3, 4, 5 years. So spend time with different houses and understand their process, their dynamics. Do you want to work with them? So yeah, hopefully that kind of answers the question.
Very, very thorough, actually. Just today, a comment in the chat, actually, together with from Azim, as would he put a question in the Q&A? What is the feeling at the moment? Is it a buyer's market, and are there deals to be done and bargains to be had? We're actually looking for the next acquisition. And he says in the chat, my business is commercial cleaning, and we're looking for the next acquisition. So if anyone knows anyone looking to exit or retire in the FM sector, then I'd be interested in having a chat. That's a Gemini GRP. So, Keith, I mean, Azim asked the question, is it a buyer's market, and are there deals to be done?
Well, yeah, there are, obviously. I think if you think about the impact of the budget and that continued uncertainty as to what's coming from a capital gains tax perspective, it's not necessarily the case that everyone's being driven by tax rates, but it's certainly, I think, fueling the demand for people considering their options. And I think, as I said earlier, that the COVID impact has meant that people, if you're a business owner and you've been impacted by it negatively, how are you responding to it? And if you're of a certain age, maybe, or you just don't really have the enthusiasm for it as much as you once did, then the chances are you will be now thinking about, well, before the tax rates go up and before I have to spend a load more money investing in my business or having to find new management teams or what have you, is the best thing to do to look for a buyer. And obviously then the scales tip, and then it becomes, you know, more of a buyer's market where they look for those sorts of opportunities, I guess. So from that perspective, I think it depends on the business and it depends on the attitude of the seller. But if you're in a certain space where maybe there aren't as many barriers to entry, or it's not a business which has got, you know, any sort of unique technology or intellectual property or brand to it, then it's going to be more attractive for a buyer, and it's probably going to be a better deal to be done, I suspect. So yeah.
On Azim's point, Chris, yeah, I think you've. So on Azim's point, I think you've just connected on LinkedIn. I've got something you might want to buy, so I'll connect with you later. We might just set up a deal.
Yeah, Richard. I mean, obviously there's a finder's fee here, and I found them. That's all I'm saying. So we've got a question from Medina Barker from CNC Robotics, fantastic business actually, based out in Liverpool. I think Medina, I think you set the business up with your husband actually, and she asks, what trends are you seeing for acquisitions in the advanced manufacturing sector? So, all right. So Azim has said, Chris, I will get you a curry if the deal is done. Well, thanks, Azim. It's going to be an expensive curry. Yeah, so in terms of Medina's question, what trends are you seeing for acquisitions in the advanced manufacturing sector? Who wants to answer that one?
I can have a go unless anyone's got. I guess it depends. I did sold a business similar to that 18 months ago, but it was in the automotive sector. And it was a great deal for the sellers. So I think it depends what sector you're in and who you're machining for, I suppose. We certainly, that particular transaction was an amazing deal for the sellers in a business that looked like a good buy. The world collapsed a little bit shortly after that, and it's been a little bit of a challenging time. So I probably don't have any massive sector insight for you, other than to say, you know, the same rules would apply to your business as any other that's being sold. You know, how good are you at it? What do you do? And who do you do it with? So, I mean, Kieran and Paul will no doubt have some general sort of comments on that. But if you're selling into automotive, that might not be as good as if you're into other sectors.
It's interesting there's a lot of stuff happening at the moment in the world of manufacturing and advanced manufacturing. I mean, I do a lot of work in Rochdale, and they're looking to open up a manufacturing productivity centre called AMPI. No, I mean, the thing about thing about CNC robotics. He's got a good trading history as well. So no, thank you very much. Hope that answers the question, Medina. Paul Nichols, don't think that's the actor, said, when would you advise businesses to engage with corporate legal for potential sale? I suppose it's as early as possible, but Keith, what would you say?
As early as possible.
See, my advice is free, but you charge for that advice.
That's £250, yeah. No, I mean, it just makes sense to create the relationship at the right level. And as Richard said earlier on, the sooner you get advisors around you to help you with that thought process around how do you want to get to where you need to get to, and who do you need around you. Well, that's the opportunity for someone to come in and help you iron out those issues we talked about earlier in terms of the litigation, the share ownership, and all the rest of it. Get your hands on your documentation, settle your documents, but also introduce you to the right people. And I think that whether you're engaging early with your corporate finance advisor or your lawyer, they will know the right people so that you've got your team. And your team really involves your legals, your financial support, and probably your tax advisor as well. And the sooner the better you start talking so that people can get those contacts ready. And then you can start planning for your journey.
Can I just add to that, Chris, that, and Paul, you probably back me up here, but also use a lawyer who is experienced in what you're trying to do. So don't just use your mate down the road, Clive, who did your house sale 5 years ago. It just creates more problems than you think it's worth. And Clive might be £5 an hour, but he won't be able to do what you're trying to do. So get experienced advisors on board. And Paul's not.
I totally support that, Kieran, and I'm not saying this because we're in a room with corporate lawyers, but from experience, businesses that I've bought in the past, smaller businesses with smaller lawyers, inexperienced, it just slows up the process and it causes more problems as you go through. And Keith and Richard will be pleased to hear it. I do believe that every penny that you spend on a good corporate lawyer will earn you something at a transaction.
No, thank you very much, Paul. I mean, Keith, we spoke last week, and I think you did a deal recently, and you literally did it in about weeks, I think 4 or 5 weeks. But that's not typical of the market. I mean, would you expect, if somebody wanted to sell their business, say, and you were to pull it back to when they should start the process, would it be typically 3 months, 6 months, 12 months? I mean, is there an average?
No, I think it needs to be almost 12 months plus in many ways, because if you want a certain amount of, let's say you want a certain capital return, you're looking for a certain amount of money. Well, you need to speak to an advisor who can give you a feel for what sort of performance your company's going to have to put in to get you that outcome. And that means that the point at which you sell might need to be a year, 2 years, 3 years away. And what sort of steps do you have to take to deliver that growth for the future, to make sure you get that multiple, to make sure you're able to demonstrate you've got maintainable earnings, to get that capital amount out. So it could be that far away. But let's assume that you're in a space where, the advice is, yes, you can pretty much get what you want if you sold today because the numbers are there and so on, the market's there. Then, it can be done in a matter of weeks. But I would say that the process of finding the right party, engaging, negotiating, whittling it down, granting exclusivity and so on, you're probably talking about a good sort of 6 to 9 months.
And I've got a question here, which is the final question, actually. Nicholas Buxton says, what impact does the panel think the various tax deferrals, C bills, CL bills, if that's how I pronounce it, will have on the ability to speed up on CapEx, growth, etc.? Risk of zombie companies, lots of companies only surviving, to service the debt. And does this represent an opportunity for buyers? That's from Nick Buxton. Yeah, I mean, there's going to be a few casualties, isn't there? So, I mean, if I start with Kieran and then I'll go around the room, what do you think about that, Kieran?
I'll try and keep it brief because I do have a tendency to ramble on, and certainly about things like this. Look, I think zombie companies is interesting. That there are companies that are clearly being supportive at the minute, and I do worry about the knock-on impact of that. So basically, through COVID, a lot of businesses have concentrated on liquidity, deferred payments, built up overdue creditors, taken on the likes of CBILS loans if they're available to them. But all you're really doing is racking up more debt without enhancing the size of the business. Now that has to cause problems, because it's not sustainable. And I think, unfortunately, you're going to see a knock-on impact of that over the next 12 to 24 months. That'd be my very quick summary. I think just to balance that slightly, I think some of the things that the government have introduced have definitely been of use, but I think people need to be careful that it's not a solution, it's not a fix, it's kind of been a temporary support.
What would you say, Richard?
Yeah, I would agree with that. I think that I actually see it as an opportunity though. I think the big unknown is the government support, but as Kieran says, just because it's there doesn't mean that you should take it. I mean, you've got, this is going to have to be repaid. That will cause some businesses to struggle, and it might offer acquisition opportunities for bigger businesses to go and help them out. And I think insolvencies can be viewed as bad news, but any insolvency lawyer, they don't call themselves insolvency lawyers anymore, they call themselves restructuring lawyers. That marketplace is sometimes much maligned. It can be a real driver for growth, and it can actually give really good outcomes for businesses that just need to just pull the ripcord. So I think there will be opportunities, definitely. I agree with everything Kieran said about the fact that this money is going to have to be paid back, and people who just took it in the absence of a plan, as Paul talked about, if it was taken as part of some good strategy and thinking, maybe not, but plenty of people just took the cash because they didn't have another answer.
Okay, Keith, and then I'll finish with Paul. What's your answer, Keith?
Well, I think that it's the opposite. For many businesses, actually, there's an opportunity to draw the cash down and then actually use it and invest it and make yourself more valuable. Really use it to enhance your own growth. And so maybe not as much looking at it from the downside, but looking at it from the positive side. I think there are companies out there who've been able to take full advantage of this and actually enhance their worth. Therefore, yes, it has to be paid back at some stage, but hopefully when you're looking at final exit, it'll deliver that extra value on top of what you're originally expecting. So that's good news.
Thank you. And Paul, when all this madness is over, it'd be good to catch up at a Costa Coffee, and you can bring a glass of water with you.
But a party.
Yeah. But what do you think is going to happen?
I think that there is one problem of paying off the debt when that's due. I actually think a bigger problem is the government support is finite, and it will mask businesses' trading performance. So as whatever it is, whether it's the C-bills or whether it's furlough support, there's going to come a point when liquidity is really going to hit some of the struggling businesses, and I would think second half of this year there's going to be a fair bit of activity in that space. And to Richard's point, it is about restructuring. So that in an economic cycle, that's a natural event, because that's what happens. Businesses struggle, and then resources need to get reallocated to businesses that can optimize those resources. So it will be an opportunity, I would think, later this year, next year, definitely for restructuring, for buyers to look at assets, because there's definitely going to be a little bit of tension second half of the year.
Paul, there's been no tension in this webinar this morning, so thanks very much to all our speakers, to Paul, to Keith, to Kieran, to Richard as well. Thanks very much for the audience as well. I always think with an event like this, it couldn't happen without the people behind the scenes pulling all the strings, getting none of the credit. So thank you very much to Teresa Deeney and Charlotte Quick from Napthens, who have been working their magic behind the scenes as well. Thanks very much to all of you as well. I think it's really encouraging when you hear the stuff that we've heard. It's very easy to believe what you read in the mainstream press. Don't do it. Formulate your own opinions based on the facts as you hear them. Deals are getting done. Money's being exchanged, and I think the portents are good for Lancashire. So thanks very much, everyone. Stay safe. My name has been Chris Maguire and continues to be so. Take care.
Thanks,
everybody. Cheers.
everyone.